Welcome to the Compounders Podcast, where we explore the anatomy of public company wealth creation stories. On this show, we invite you to be a fly on the wall for the actual conversations professional investors have with public company CEOs. I'm your host, Ben Claremont, a partner and portfolio manager at Cove Street Capital. In these conversations, I interview senior executives by posing the exact questions I ask as part of Cove Street's diligence process. Whether you are a professional investor, founder, or someone who is simply interested in business, we think this podcast has something for you. This season of Compounders, the Anatomy of a Multibagger, is sponsored by Tegas. Tegas is an innovative and disruptive company that is changing the way professional investors work. For more information, please visit their site at tegas.co.
All opinions expressed by your hosts and the podcast guests are solely their own opinion and do not reflect the opinion of Cove Street Capital or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
Our guest on the show today is Tom Logan, the CEO of Mirion Technologies. Mirion was founded in 2005, and Tom has been the company's only CEO over that period of time. Mirion is a global leader in radiation measurement, serving end markets such as nuclear, life sciences, healthcare, and industrial. Mirion recently became publicly traded via SPAC, but unlike many other de-SPAC companies, Mirion has a long operating history and generates positive EBITDA. The company has had to weather a number of headwinds over Tom's tenure, including the Great Financial Crisis, the Fukushima nuclear disaster in Japan, and of course, COVID. Despite that, the company has grown consistently through organic and inorganic means and expanded its margins meaningfully. With all of that as a backdrop, I was excited to talk to Tom about the current state of the base of nuclear power plants around the world and how the Russia-Ukraine conflict is impacting nuclear policy, how the company is positioning itself to grow within the medical end market, what he has learned from Mirion chairman Larry Kingsley, who achieved tremendous success as CEO of IDEX and Paul Corp, the elements of the business model that lead to sticky recurring revenue, and how the company hopes to achieve its mid-single-digit growth algorithm. For full disclosure, Cove Street is not a Mirion shareholder. And without any further ado, here's my conversation with Mirion Technologies CEO, Tom Logan. As always, we will start this podcast off at a pivotal moment for the company. In the case of Mirion, the company was founded in the early 2000s, but recently became publicly traded. Why was this the right time in the company's evolution to go public?
Well, Ben, firstly, let me say it's a pleasure to be with you today. We love the opportunity to tell our story and to have an hour with you. I think it's going to be a great experience. But cutting to the question, first let me give some context. I'm the founding CEO of the business. I've been in role now for more than 18 years. And so over that period of time, you can imagine we've seen a lot. We've seen a lot from a macro standpoint in the markets, where the modern era of Myriad really takes us from the financial market collapse, the Great Recession on one end. I would say COVID on the other end, but it's now also the situation in Ukraine as well. Throughout our history, we've had a tough external market to deal with, and so despite that, we have been successful in building value, being a compounder, if you will, and we've seen a lot of pivotal moments. But the highlight probably for me of that period of time was, in fact, taking the company public last October through a SPAC. The reason this was the right time to go from private to public, in part was a function of timing, where historically we have been a private equity owned asset. We've had two different private equity sponsors, and as you and your listeners know, there's a life cycle to private equity deals. So part of the answer is that it was time for us to, essentially cross that bridge. But in terms of, why public, why a SPAC, there's a lot there, but I would tell you that fundamentally we want to build a great company. We're very pleased with what we've done historically, but we want to take our place amongst the ranks of the great industrial technology businesses. And to do so is going to require not only consistent future organic growth, but also inorganic growth. And in my view, becoming a public company, fosters that trajectory to the greatest degree in terms of capital availability, cost of capital, et cetera. So it was the right time for us, and really, I think, an important catalyst for the next chapter in our history.
And we're going to dive into, some of the stability we've seen in the business in addition to M&A and capital allocation. But I want to just double click a little bit on the going public via SPAC. Obviously, SPACs have been on a little bit of an interesting roller coaster recently. The markets couldn't get enough of them during most of 2020, and now the market seems skeptical of so-called de-SPAC companies. So how would you respond when potential investors ask about the logic of going public via SPAC versus maybe, an IPO or, some other way of becoming more publicly traded?
Yeah, firstly, I would say that as a generalization, we are a very different company from most SPACs. We have a long history. We have a substantial top line, and perhaps most importantly, we're profitable. We actually have EBITDA, unlike many SPACs. The reason we chose a SPAC relative to a more conventional IPO really, again, relates to the private equity ownership of the business, where our former majority shareholder is a private equity fund called Charterhouse Capital Partners. We were the last asset in their 9th fund, which was a 12-year-old fund. They're out managing their 11th fund now. And when you look at the liquidity tail associated with a conventional IPO, in particular for a selling private equity sponsor, that tail can be easily 5 years, potentially longer, because of their inability to take liquidity at the time of the IPO or the limitations on that. One of the very appealing things about the SPAC market is that they had the ability to gain substantial liquidity at the time of the de-SPACing event overall. And so for us, it really was the Goldilocks scenario. It was the optimal way of transitioning the business again to a public status, but doing so in a way that really met the needs driven by the fund dynamics of Charterhouse Capital.
And I'm really interested to dig into the business because my guess is that most people are not familiar with products that measure ionizing radiation. It's just not something you see, particularly often as you're reading the Wall Street Journal. So, could you talk about your products a little bit and in your end markets? And then I think, I'm always really interested in what problems you're solving for the customer, that gives you a value proposition.
Mm-hmm. Great. So let me give you the context. Firstly, just to note that we describe ourselves as being the global leader in radiation detection and measurement technologies, and that our mission really is focused on harnessing that domain knowledge for the greater good of humanity. Perhaps the starting point in the discussion is really to talk about why ionizing radiation. That sounds like a very arcane field. It sounds very limited, very technical, very boring to many folks, and it's none of the above. The starting point is that ionizing radiation is radiation that can cause tissue damage. It's alpha, beta, gamma, X-ray, and neutron exposure. It's not microwave exposure or anything else on the electromagnetic spectrum. And the market that is associated with the management or the harnessing of ionizing radiation in aggregate is about a $17 to $18 billion market. So it's a rather large market. The corner that we play in today is about a $4 billion currently served market, of which we're just over 700 million in terms of the run rate of the business. So the starting point is that it's a good sized market. And it's comprised of a lot of different segments, which we can get into a little bit. But the reason we focus on this is because our core domain knowledge, which we believe is second to none in the industry, is highly fungible across vertical market boundaries and across market segments. And what that means is that the developmental work that we do in one area has leverage in many or all areas of our business. And so it gives us the ability to grow again in a large market with a niche that is compelling, attractive, and leverageable in a way that allows us to grow to substantial scale, really without conglomeration. It gives us the ability to do so with a high degree of coherence overall. And let me give you some tangible examples. One of the smaller segments that we play in is we would just generically refer to it as kind of the big science space. We are leaders in working in this space, and some of the bragging points that I would put out there would include the fact that our instruments were used in the discovery of the last 9 elements on the periodic table. Our instruments have been broadly deployed on most of the significant interplanetary space probes over the last several decades. In fact, our instruments literally confirm the presence of water on Mars. We're on the International Space Station. We have developed instruments for the Mars mission. We're deeply involved in the space community, but also in the particle physics community, where our products are really critical in the quest for better understanding of particle physics, which leads to a better understanding of the origins of the universe. The importance of all of that is, firstly, that demonstrates our technological capabilities, particularly in terms of detector design and the material science that goes with it. But perhaps more importantly, we have a long history of taking things that we develop for those bleeding edge scientific applications and taking them out of the science lab, putting them into a different form factor, figuring out how to produce them at industrial scale and at attractive cost points. And this really is the key to our business. It allows us, again, to really be innovation leaders across the vertical markets that we compete in. Now, as we think about our markets and, really what are the problems we're trying to solve, there's some common characteristics. Firstly, I would note that if you look at the breakout of our revenue, what you would find is that about 38% of our business is associated with commercial nuclear power. About a third of our business is for healthcare applications. And then following that, we have significant exposures in defense, both military and civil defense, in life sciences with various types of laboratory instruments that we produce, then in other industrial applications. And if you look at the common characteristics of these markets in general, what you'll find is that we are selling compulsory solutions. It could be a piece of capital equipment, a technology-enabled service, software, or some other solution into markets that are highly regulated, where the cost of failure is high. Typically, the relative wallet share of the products or solutions that we're selling is low. There is a relatively concentrated competitive environment, and once we become the incumbent, effectively the defensible moat becomes rather deep and large. So importantly, once we gain a foothold, we're highly likely to be able to defend that foothold for an extended period of time. And as a consequence, if you look at our revenue profile, what you would find is that nearly 3/4 of our revenue is either repeat or recurring in nature. It's predictable, it's visible, and this leads to a very important characteristic of our business. Essentially, what we are selling, to perhaps oversimplify a little bit, is safety. We're providing systems and again, instruments, software, and tech-enabled services that monitor human health, that monitor environmental health, and provide feedback that is helpful to really understand the nature of potential threats from a defense standpoint, et cetera. So, this again takes us back to our mission of really harnessing our domain knowledge for the greater good of humanity, which perhaps is a little bit more intuitive after that description.
Compounders is brought to you in partnership with Tegas, We created Compounders to uncover the lessons and frameworks of the best capital compounders in the world. And if you are a professional investor, VC, or operator, and you appreciate the deep research into the businesses explored on this podcast, check out tegas.co/compounders. With Tegas, you can learn about any company directly from former execs, current customers, and industry experts, all of which are in position to offer unique insights into a company's growth, its customer value, and its competition. What makes Tegas different is that you don't have to lead your own expert calls. The platform offers instant access to the world's largest collection of investor-led call transcripts on companies such as Compounders guests, Viasat, Element Solutions, and Avid Technology. All you have to do is log in and you'll get instant access to nearly 25,000 expert call transcripts. And the best part, the Tegas collection grows larger with each investor and company that joins. Still want to do your own expert calls? Tegas is the right solution. Experts that are just as good or better than what you'd find on other networks, but starting at just $300 per call, not the $1,000 or more others charge. If you're ready to go deeper on the next compounding business, head to tegas.co/compounders for a free trial. I can personally say that having access to the Tegas platform and Rolodex of experts has fundamentally changed the quality of due diligence Coast Street does on both new and existing ideas. I think when people hear nuclear, they maybe have a knee-jerk reaction of, well, I mean, we hear a lot about decommissioning. We hear about Germans shutting down plants. We talk about how it's really hard to build nuclear in the U.S. right now, given the permitting and the cost structure. So maybe frame that, the nuclear market and has it been shrinking? Has it been growing? I know you work on both decommissioning and new builds. So just for people who aren't familiar with on the ground nuclear activity, what have you seen over the last maybe 5 or 10 years?
Yeah, what I would tell you is that the nuclear power market is a very strong market, and I believe it's likely to continue to be so for an extended period of time. It is a growing market, and it has a number of facets to it overall. But in the nearly 20 years that I've been in role, I would tell you that the overall health and vibrancy of the nuclear market today is stronger than it has been at any point in my tenure with Myriad. There are really 3 key areas within commercial nuclear power that we play in. One is we support the installed base. And, again, just putting into context, nuclear power is about 38% of our revenue. Of that piece of the pie, about 3/4 of that revenue is associated with the installed base, where we are providing spares, maintenance-related support, system upgrades, and other solutions that are necessary over the operating life of a nuclear power station, which in modern terms generally tends to be in the 60 to 80-year range. Some plants may end up operating literally for a century, which is an extraordinary thing to conceptualize. But these plants are very robust and have very long operating lives overall. I would tell you that when you're looking at the health of the installed base as a starting point, just to put things in context, today there are roughly 450 operating nuclear reactors globally. I believe that about 93 of those are in the U.S., and the balance of the concentration is mainly in Europe and in Asia overall. A relatively light southern hemisphere coverage overall. The 2 key factors that drive the health of the installed base are, firstly, political support, and secondly, it's economics. On the political support side, politics are complicated. They vary by region, and they're informed by different motivations that may include the sanctity of energy supply, the desire to decarbonize an economy, the relative abundance for a given nation state of other alternative forms of carbon-based energy, the relative demands on the grid, a whole host of other factors. Generally speaking, what we see today is that the political support on a global basis, again, for the install base of nuclear power is very constructive. Countries that have been on the fence, particularly in Europe, in light of the recent events in Ukraine, have come out in a fairly rapid, fairly remarkable fashion, declaring their support for nuclear power. Perhaps most striking in Belgium. We've also seen in the case of South Korea, which is very important. A nuclear powered economy overall, that with their recent presidential election, there's a strong pivot in favor of developing more nuclear power in country. So on the first point, political support, we're seeing very notable positive movements in favor of political support, again, for some of the reasons that I've cited. The other key factor is economics, where a bit of an oversimplification, but I would argue that the single most important factor in driving the overall economics of the installed base of nuclear power plants is the price of natural gas. And that tends to be a bit regional in nature, driven by supply constraints, limitations, and costs associated with liquefying and transporting natural gas. But if you look at the recent history over the last 3 or 4 years of natural gas pricing, it's increased substantially for a whole host of reasons, both supply-driven and demand-driven. But again, with the recent events in Ukraine, it really has called into question the supply equilibrium in Europe in particular, where Europe today gets about 40% of their natural gas from Russia. And clearly, there are limitations today that may extend well into the future. In the American market, we've seen a slowdown in some of the shale gas exploitation activities. We're seeing depletion profiles, changes in demand, et cetera, a whole host of factors that are driving up that cost of natural gas. But the bottom line is that it's essentially more than double year over year and is likely to stay at a high level. The result of all of that is that economically, the installed base of nuclear reactors globally is stronger than it has been at any time in the last 2 decades. And that, coupled with political support, makes that installed base very healthy. So that's the biggest and most important piece of the nuclear power related revenue that we receive. And the consequence of that, I should note, is that in general, the operators of nuclear power stations will want to run them at higher capacity factors and to extend the lives of these power plants, all of which favors the recurring revenue cycle and upgrade opportunities for our business. Recognizing that we have a presence in more than 90% of the installed base of reactors on a worldwide basis. The second major element of the nuclear power market is new build activity. And again, we're seeing substantial growth here. That growth, to be clear, is not in the U.S., where there is a little likelihood that we will see a net capacity increase in the American market. But where it is happening is in Asia and in Europe, and it's happening again in a very robust fashion, particularly in comparison to what we've seen over the last decade in particular. The growth in new build activity for us is the fastest growing segment of our business overall. And while we don't share our internal estimates, if you were to see those and correlate that with our backlog, what you would find is that we have aggregate coverage for the next 5 years of better than 70% in our backlog. And if you add to that our bid pipeline, RFPs and RFQs that we're currently responding to, that coverage approaches 90% or so. And behind that, we have additional new build activity that, again, is kind of hastened by the recent events in Ukraine, where we believe that there is a reasonable possibility that we'll see an acceleration of certain nuclear projects in the UK and France and Poland, in the Czech Republic, and in other markets overall, all of which will further undergird the growth that we're seeing today in new build activity. And again, this new build activity is driven by some of the factors I cited before: a desire to decarbonize the global industrial energy production, energy security issues, economics, a whole host of other factors. Our view is that in general, the net capacity or net output of the nuclear industry will grow slowly. It'll grow at low single digits, but it will grow predictably, and it will grow over a period of 20 to 30 years or more, just based on the current generation of technology. And within that, understanding that growth is net growth, that is net of decommissioning activity, which is the final piece of the puzzle. On the decommissioning side, reactors that were built in the 60s, 70s, in some cases in the 80s, are aging out. They are decommissioning because for specific reasons, those plants are no longer viewed as being economic or being strategic. This is a very predictable demographic. Right now, we're kind of at the leading edge of that phenomenon. This market opportunity for us today is about a little bit less than 10% of our nuclear power related revenue, but it will be a growing percentage. This is a market that will grow at an upper single digit rate overall. And so I guess the net takeaway from all of that is that even though the nuclear industry is growing at a relatively slow rate, that growth is typically measured on a net basis, meaning installed base plus new builds minus decommissioning. For us, the equation is different. It's a gross equation. It's installed base plus new builds plus decommissioning. And based upon, again, political support, economics, and other factors, market conditions are very, very strong right now.
Well, you preempted my questions about Russia, Ukraine, and how that would impact you, and also, jumped ahead a bunch of questions. So that's great. I think that's a really good overview of the nuclear business. I wonder if we could use the nuclear business as maybe to highlight the stickiness of this business. So maybe talk a little bit about, as in using nuclear as an example, like, is there if you're on the new build, are you, is there likely a recurring aspect of that in terms of maintenance? And then let's say you do get on some kind of more recurring maintenance side. How sticky is that? How hard would it be to rip you out? I mean, I'm just trying to get a sense of stickiness and moat, and with nuclear being a good example of that.
Sure. So one thing to note is that we've got a very strong market leadership position. In our internal calculus, we have 17 major product categories, and we believe we're the global leader in 14 of those 17. And this is very, very important when you look at not only the opportunity to compete to get into a new nuclear power plant or beyond that, a military installation, a life sciences lab, a cancer clinic, a radiotherapy clinic, whatever it may be. That brand equity that's been built up over a significant period of time, which is best expressed through, again, those leading share positions, is incredibly important. But beyond that, again, just given the characteristics of not only the nuclear industry, but the other verticals that we compete in, where the regulatory environment is challenging and the regulatory hurdles are high and expensive to crest. Cost of failure for equipment can be very high and is a huge issue, a huge area of concern and focus for our customers. And, the products that we sell are compulsory, whether somebody buys them from us or from somebody else. And so the result of all of that is that the competitive field is relatively concentrated with a handful of large players. We believe we are the leader, again, in most of the segments that we compete in. And so as a consequence, that tends to give us a bite at the apple, an opportunity to compete on the front end, depending on the market, depending on the nature of the product. Once we become the incumbent, because the products and solutions, I should say, that we're selling tend to have an ecosystem. It's not just a single product, but oftentimes it is a product associated with software, with accessories, with readers, a whole host of different product elements to them. And the nature of that ecosystem is such that switching costs, once that ecosystem takes root, tend to be high. And I'll give you an example. One of our franchise products is something called an active dosimeter. This is a a smartphone sized device worn by individuals that it does two things. It provides an active reading of the dose rate that individual is being subjected to. And secondly, it will calculate the cumulative dose that individual has been subjected to. Within a nuclear power plant, everybody wears one. Workers, visitors, anybody who is in a restricted area within a nuclear power plant will wear a dosimeter. But if you look at the dosimetry ecosystem, it consists not only of the devices, and in a typical power station, they will have several thousand of these devices, but it's readers, it is software, it is accessories that are associated with the dosimeter. It is telemetry streams that are again correlated with that specific dosimeter. So at the end of the useful life of a given fleet, so let's assume that we're selling into a new power plant. We expect that collection of several thousand dosimeters will last for 10 years or so. When that operator is then confronted with an upgrade decision, they have the opportunity to either take on an evolutionary upgrade where our products are the new elements of whatever the then current releases will be backward compatible with their existing fleet. It allows for more seamless transition overall versus doing a wholesale change out. So fundamentally it comes down to switching costs. And a key part of that is not just the capital equipment, but it's the training costs and the integration efforts internally. This pattern can be extended more broadly to much of what we sell, which is one of the reasons why we enjoy that high recurring revenue.
And getting deeper into the recurring nature of your business and the stability of your business, some interesting slides in your presentation highlight the fact that this company has had pretty consistent growth, obviously with a few blips here and there, even despite living through, global financial crisis, COVID, and obviously now the Russia-Ukraine situation. So maybe just talk a little more about that stability. Like, is it, obviously there's a recurring aspect of the nuclear business, but maybe as you think about the whole business where, a lot of companies have suffered during that period, especially industrial focused companies. So what do you attribute that stability to?
Yeah. Well, I would tell you, we're very proud of our track record. If you look at the history of our company, and you've seen this, Ben, you've seen that we've delivered since we formally created Mirion in 2005, we've delivered a top line growth CAGR of about 12%. About a third of which is organic. The balance is acquisitive. And if you were to compare that with best-in-class industrial tech firms over the same period of time, it puts us into the upper ranges of that peer group overall. During that time as well, we've driven an EBITDA margin expansion of well over 1,000 basis points, and we've created a lot of value as a business. And to your point, despite the challenges of the macro environment, we've been very resilient. And it was not just the global financial crisis and COVID and now Ukraine, but in the midst of all of that, we had the Fukushima incident, which created a lot of uncertainty in the nuclear power segment, the nuclear power industry overall. You had the bankruptcy of Westinghouse and the restructuring of Areva, the two largest, most significant players in that nuclear power ecosystem. We had another recession in between. We've had a trade war underway between the West and China. Yeah, so it really has been a bit of a tale of woe in terms of the external market dynamics. But we've continued to thrive, grow very predictably. We've had great resilience to the downside. And one of the key reasons for that is the inherent diversification in our business. So even though our strategic focus is pure, it's again on ionizing radiation and leveraging this domain technological knowledge that we have and leveraging the advantage associated with that, But despite that, if you're to look at the demand patterns across our vertical market boundaries, beyond nuclear power into healthcare, into defense, into life sciences, into other industrial applications, you'd find that there is a strong inherent diversification effect that leads to part of that robust demand profile, but also again the compulsory nature of what we sell. So even in down markets, our customers have to essentially buy the dosimeters, buy the instrumentation that we are providing across these different vertical market boundaries. Combination of all of those factors tends to again create a very defensive characteristic for our business overall. But importantly, we think of ourselves not as a defensive play, but as a compounder, where our history of organic growth across in all weather conditions, all market conditions, is something that we solidly believe we can extend into the future and continue to supplement with inorganic growth. So even though we've guided publicly, mid-single digit organic growth on a forward-looking basis, we expect that we'll add 5 to 10 points of inorganic growth to that annually. And our view is that we can drive EBITDA margins from where they are today at about 25 points to 30 points in the future. So the complete story is not one of, again, just purely being a defensive stock, but really being a compounder that has very attractive protection to the downside.
And if we dig into that organic growth projection and mid-single digits, I'm interested in what the puts and takes would be on exceeding or not making those goals. So what where would you think there'd be upside to that, and on the flip side, like what would be what would have to happen, do you think, for you to be challenged to hit those goals?
Yeah, so there are a few different factors underpinning it. We frame those goals with the view that the commercial nuclear power sector would be growing at low to mid single digits, in our segments, that our healthcare exposure would be growing at upper single digits, and that just as a function of the weighted mix, that would drive this overall kind of mid single digit organic growth profile. What's changed a little bit is firstly, as a result of many of the global issues, black swan events, if you will, that we've seen, is that firstly we think the overall dynamics within nuclear power are a little bit better than they were at the time we framed that forecast in terms of installed base new build activity, little change in decommissioning activity. But the other thing that we've seen is that the prevailing view on inflation has gone from one that is rooted in, this is transitory and we'll move through it, to a view that the inflationary pressures that we're seeing now really represent a fundamental secular change and are going to be with us for a while. If you believe that, given the fact that the nature of our product positioning and our product mix is that we think we can favorably manage the price cost relationship, meaning we believe we can stay ahead of the inflationary pressures on our cost structure. That would argue that on a nominal basis, this is also an incremental factor that would tend to support organic growth, in the well supported in the range that we've guided overall. The things that might undermine that would be that if the world does lapse into recession and we see a change in government spending dynamics, those things could be negative factors overall. But when we've seen that historically, I would note that we've been through sequestration and tight budget cycles in all of our global markets, and that it doesn't tend to be a major effect. But these are the types of things that could represent overall risk to the growth profile. I would tell you though that on balance, when we look at overall market conditions and where we sit competitively, we feel pretty good about the guidance we've given.
You mentioned M&A a couple of times so far. And this company's made a number of acquisitions since 2016. So maybe you can describe the acquisition landscape and what that looks like for Mirion. And then when you are achieving synergies, what type of synergies are you capturing?
Sure. So when we look at M&A, really, just to quickly describe our process, the process really is driven by our market views. That we do an annual deep dive on the key market segments that we're playing in and those that are of interest to us. And we use that to really drive our capital allocation process, not only the external capital allocation, but also internally, where we want to dedicate money to R&D expenditures, capital budgets, even operating budgets overall. But from an M&A standpoint, thematically, as we guide our activity with that market view, we then use that to drive the ideation. What are the opportunities that are out there that are actionable? One of the things that we do that may be a little bit less common than others is that in addition to tapping into bankers and consultants and expert networks for M&A ideas, we also crowdsource our internal employee base. So we have about 2,600 employees globally. I address the top 500 or 600 managers at least monthly via virtual town hall calls. And a standing agenda item is M&A. We talk about it every time I have these internal discussions. And I always ask people for their ideas. And we even have an email address that goes straight to our head of strategy. It's acquisitions@mirion.com. If you have a great idea for us, we look at all of them. But I'll tell you, we've received hundreds of ideas internally. And the great thing about crowdsourcing your internal base of colleagues is that the good ideas that you get, and most of them are not actionable, but I'd say somewhere between 5 and 10% of the ideas that we get are really, really smart. And importantly, they come with relationship capital. It's somebody who it's a manager in the supply chain who says, I see a great opportunity for us to vertically integrate by buying this company, and here's the person you should talk to. Or it's somebody in the commercial organization, sales or marketing, that says, here is a competitor that has a really cool new product. It's a startup. We should talk to them. Here's who you should talk to. It's that type of thing. And as a result, if you were to look at the last dozen deals that we've done over the last couple of years, what you would find is that a majority of them were not competitive auctions. These were not banker-run processes, but rather opportunities that we cultivated and engaged on a bilateral basis with a seller. And that's a really important part of our M&A process overall, and one that I think we're good at. If you're to look at our ability, again, to cultivate ideas, generate a pipeline, I think we've proven, over many years that that's something that we're good at. The next step is getting the deals closed, and we're a company that prides itself on being, fair and above board, and an easy company to transact with. And so our track record of getting deals closed in a rapid fashion, in a predictable fashion, is good. But ultimately, we're good at integrating. Where if you're to look at I think you've seen in our materials, Ben, that at the time of our pipe raise, the last 10 deals we had done at that time had an average acquisition multiple of about 12 times EBITDA. But even within a 2-year period, the average post-synergy multiple was about half of that, about 6 times TTM EBITDA. So, we're good in the integration and good at making deals quickly accretive. The way we do that depends on the nature of the asset that's being acquired. In some cases, we've bought assets that need a lot of restructuring. Effectively are turnarounds. And in those cases, we have to be very focused on cost takeout, rationalizing industrial footprint, and really kind of reorienting the commercial activities of the business. In other cases, we've bought, very, very well-run platform investments where, we're adding to we're investing more behind it rather than taking costs out. What matters is that our integration strategy is situationally appropriate, and that we execute against that well. And I think our track record, proves that to be the case.
And as you think about where M&A is going to fit in terms of your capital allocation budget, how do you see M&A fitting going forward? And where does that fit specifically relative to, paying down more debt?
Yeah. So that is the key issue, is that right now, if you were to look at our leverage multiple, so this is our net debt as a multiple of our EBITDA. Right now, we're running at just under 4.5 times. Our guidance is that we expect to be at or below 3.5 times within our planning horizon. So we are in a mode where we're very focused on deleveraging the balance sheet. Parenthetically, I would note that as a private equity-backed company for nearly 2 decades, 4.5 times leverage is an absolute walk in the park for me and the management team, because customarily we've carried leverage at 6 times better or higher, and done so comfortably, and obviously grown the business effectively and with low volatility to the downside, and that's a function of strong free cash flow generation. Again, just many of the dynamics that we've touched on today. But to be clear, given the nature of our free cash flow, which is better than $100 million a year, and again, noting the guidance that we've given of 5 to 10 points of inorganic growth in addition to the organic growth, we can achieve that while deleveraging the balance sheet. And because if you do the thought experiment of figuring out what that means, you're talking about roughly $35 to $70 million of incremental top line growth annually, and if we're buying companies with 20% EBITDA margins, then that's $7 to $14 million of EBITDA on a pre-synergy basis. And if we're paying 12 times EBITDA for that, then that's going to be 84 to 168 million. And so even at the upper ranges there on a pre-synergy basis, with just a little bit of nominal debt, our free cash flow supports that and a net deleveraging of the business. If you then add to the equation the likely synergies that we are able to pro forma on a forward-looking basis, then the number fits far more comfortably in that range. And so this is why we believe that even while delivering that guided inorganic growth annually, we can delever the balance sheet. Our view is that down the road, as we get the stock price up to where we believe it ought to be, more reflective of peer group multiples, we'll also have the opportunity down the road, as we think about becoming a little bit more aggressive from an M&A standpoint of using equity as more of an acquisition currency. But right now, we're focused on being a great public company, seasoning the company, strengthening the shareholder composition, getting more analyst coverage, all of the normal things that a newly public company does. And so, our view is that this is a year where we're not likely to exceed the guided range from an inorganic growth standpoint, but recognize that our quest is to build a great company here. And again, we want to take our position amongst the best in class industrial tech firms. And to get there, M&A is going to be an increasingly important part of that journey. And we feel like we're well equipped to deliver that.
And you joke about being 4.5 times levered being really easy relative to being 6.5 times levered. But I think one of the stereotypes of especially private equity owned companies is that when they're that levered, they're often constrained when it comes to the investments they can make. So I'm interested, now that net leverage levels have come down a bit, I'm wondering how, if at all, you're operating and spending differently from what you were doing when you were a little more burdened by that leverage?
Yeah, and you raise a common observation, Ben, and in our case, I would tell you firstly that our private equity sponsors throughout our history have never constrained the growth related capital that we've dedicated, again, both in the form of R&D as well as CapEx and certainly M&A related growth. We've had great sponsors historically that have taken a long-term view that we're trying to build a company that has lasting value, not try and drive financial engineering that will make it look better than it is overall. Importantly, if you look at probably the best indicator of that is our total engineering spend. And I say engineering rather than R&D because engineering for us encompasses pure R&D, but also sustaining engineering, supporting the existing product line, as well as customized customer projects. And it's a pool of labor and costs. It's a little bit fungible. It moves around a little bit in those categories. But we spend more than $70 million a year on engineering, which arguably is supporting in the main growth. And we do that across the enterprise, across all segments, because we want to continue to be the overall market leader. We want to add to that market leadership position. And where we're not number one, we want to become number one overall. Our view is that as we gain scale, that is a bit of a flywheel effect. That as we gain scale, we can dedicate more capital to product development, and as we gain scale, we also benefit from a network effect where we gain more points of presence, but also a broader product catalog, which gives us the ability essentially to sell more things to more people. And really the pulse of that, the lifeblood of that overall is innovation, where our commitment has been industry leading and unimpeded by private equity dynamics, but something that we obviously continue to be very focused on prospectively.
That's a good segue to one of my favorite questions, which is regarding a company's willingness to suffer, meaning that they're willing to take a short run hit to earnings and margins to do what's right for the long run. Maybe talk a little bit about within that, that spend, like where have you been willing to say, this is not going to generate revenue or, for 3 to 5 years, but it could be, very meaningful in the future. What kind of buckets would you put that in?
Yeah, the probably a good example here, Ben, would be a product that we developed a number of years ago called Instadose, which is a product that had its origin in technology that we developed for a big science application. The technology had been developed for CERN, the Switzerland-based European Particle Research Facility. We figured out a way of taking a very accurate scientific ion chamber and putting it into an industrial form factor. But when we started that quest, we saw tremendous commercial applications for it, but we knew it would be very hard to do. We knew it would take us a number of years to be able to develop the product. We knew that some of the challenges were not, the solutions were not obvious as to how we would confront them. But this was an area where, notwithstanding, those challenges, we funded it. And over a period of several years, we developed a breakthrough new device that essentially digitizes an analog business that we're in today, which is something called occupational dosimetry, where essentially on an outsourced basis, we are monitoring the cumulative radiation dose received by radiation workers, most of whom are medical workers. So we figured out a way of digitizing this space overall, developing this technology, and we've continued to invest very heavily in it, past the first generation into the second generation, with the third generation docketed for launch at some point in calendar year 2023. And we do so because we see an enormous opportunity to, not only, leverage our own services business, but really to make available this technology to the world as an open platform. That would be an example of a challenge that many companies would have a hard time taking on because of the high technological risk, the multi-year technological journey to get it done overall, and I think that is reflective of the culture that we have. That we're a very entrepreneurial business. We are very comfortable taking on measured risk. We're okay making a mistake as it relates to product development, technological exploitation in particular, because we always learn from those things and they always lead us in some other direction. And so that cultural dynamic of being maybe a little bit more comfortable with some of this technological risk, I think is a key differentiator of our business and has certainly paid dividends, over our history.
And you brought up culture, and in this podcast, we focus a lot on people because, companies are made up of people. So you'd assume that was important. And Larry Kingsley, who established an amazing track record of shareholder value creation at both IDEX and Paul Corp, is the chairman of this company. Is one of the things that made me interested in this company and learning more about it. Maybe talk about his role and what you've learned from working with Larry so far.
Yeah, Larry is a phenomenal executive. His track record, as you've noted, speaks for itself. And prior to IDEX and Paul, he was a very important senior leader at Danaher during their formative years, and has since gone on to chair a number of public company boards, be very involved in the private equity community. He does many, many things. He's a very, very capable guy. But importantly for me, we very quickly forged a kind of Lennon and McCartney relationship where he brings to the table a strategic sounding board for me that not only does it de-risk the public transition that we're in the midst of now, but in terms of having a strategic partner where we can't have that intellectual clash, that iron on iron kind of sharpening of ideas, has proven to be a very important already. The nature of the dynamic is that Larry runs the board, I run the company, but we talk a lot, and we talk a lot about our organic growth trajectory and the things that we're trying to do in terms of driving margin expansion, et cetera, where his skill set correlates very strongly, again, given the Danaher DNA and what he's proven in leading other great industrial tech firms, but also inorganically as we think about the journey there. He's got tremendous relationship capital, and the chemistry between the two of us is outstanding. And I think this is going to make the company better. And that candidly was one of the most appealing aspects of the opportunity to enter into the SPAC deal with Goldman Sachs was his involvement.
And I think it would be a mistake not to dive into the medical business a little bit, because it is a decent part of your business and it's growing. So maybe talk a little bit about what's attractive to you about that end market, and what's the strategy to make it a larger piece of the pie over time.
Yeah. So one of the things that many people have noticed is that over the last 3 years in particular, there has been a bit of an over-indexation. I don't want to say a strategic pivot, because that implies that we're pivoting away from our historical roots in nuclear power and defense and life sciences. But clearly, as you look at the acquisitive activity of the company, we've over-indexed on healthcare opportunities. The reason we've done so, firstly, is because it really opens the aperture in terms of the addressable market. This has been a material factor essentially in doubling our currently served market from roughly 2 billion to the 4 billion where it sits today. Secondly, the dynamics within that market are very compelling. The nature of the positions that we have support upper single digit market growth. and very attractive organic growth characteristics building on the platforms or positions that we have today. But also from an M&A standpoint, there's a bit more fragmentation and attractive adjacencies in and around those positions that I believe will keep us busy for a few years in terms of further building out the positions that we have today. So, medical is an important part of our journey, again, to continue to leverage this ionizing radiation domain expertise that I think will continue to take us deeper into the healthcare field and perhaps beyond that. To be clear, we've guided that our goal is for healthcare or medical to be half or more of our business within our 5-year planning horizon. And I remain confident in our ability to do that through a combination of stronger organic growth as well as continued emphasis on healthcare for some of the M&A activity.
And you briefly touched on margins in one of your previous responses. I'm interested in that kind of 30% EBITDA margin target and incremental margin targets around 50%. What is a path towards margin expansion look like, and how in the past have acquisitions impacted that your trajectory to more like 30% margins?
Yeah. So when we look at where we sit today, our EBITDA margins around 25 points. 2 years ago, just to be specific about public company costs and the effect that acquisitions can have on a transitory basis. 2 years ago, on a pro forma basis, we were north of 27 points. The delta between those two is reflective, firstly, the fact that we have taken on significant public company costs. The incremental public company costs for us more than $10 million. The dilutive impact of that is kind of a one-time effect. It's a burden that we take on, and then we move beyond it as we continue to grow, continue to drive or enjoy the benefits of high contribution margins, high operating leverage. Secondly, we bought an asset just about a year and a half ago that was a company about $40 million in revenue, operating effectively at close to break even. Very strategic investment for us that added to an existing position that we had in the radio pharma or nuclear medical space, where we play an important role in the overall value chain. That had we knew as we integrated this business that it would be a bit of a turnaround and would require fairly significant restructuring, which we have been quick to get after. And so if you look at the costs that we have taken out since we've owned this asset, we're in a position today where, on a run rate basis, this asset is barely dilutive to overall margins, but we expect that within the next year, again, on a run rate basis, it'll become accretive. But importantly, if you look at the short-term effect of taking on that acquisition, that had a temporary margin impact of somewhere between a point and a point and a half on overall EBITDA margins. This is something that we're willing to do. You asked about pain tolerance. This is a good example because, again, this was an enormously strategic acquisition for us, and it's a deal that we would do in a heartbeat again today. It'll be a very important part of the fabric of our company. It is today. It'll be more so in the future. But on that journey to 30 points, I will tell you that far and away the most important factor is operating leverage, where if you look at the gross margins of the business, we're in the low to mid 50s in aggregate. Given the fixed cost elements of our factory overhead, the general equation is that about 4 points of organic growth, all else being equal, will drive about a point of margin expansion, because that fixed cost structure, not just SG&A, but at the factory overhead level, grows at a slower rate. It's more of a step function increase rather than a direct variable increase. And so this operating leverage has clearly been the most important factor in the historic margin expansion that we've delivered of more than 1,000 basis points overall. That'll clearly continue to be the case in the future. But adding to that, we see an opportunity to improve and optimize our pricing heuristics, which, again, in this neo-inflationary environment we're in, is more important than it has been in decades, and something where we think that we're well positioned to drive favorable cost or price cost, margin differential. Beyond that, there are continued opportunities for us to improve operational in terms of supply chain management, industrial footprint rationalization, all of the normal elements that we're constantly, seeking to improve on through our leverage of our business system. So, when we look at this journey to 30-point EBITDA margins, again, we feel pretty good about our ability to do that. And certainly our history has demonstrated the capability of doing exactly that.
I want to ask another question about culture and people. So you've been the CEO since the early 2000s, and you've had plenty of time to shape the culture of this company. I'm interested in the values you've tried to instill in the company over that period of time.
Yeah, we are a very much a value-driven company. In fact, if you look at our business system, you'd see that it's defined not purely by the operating toolkit for the business, but it's also defined by governance and culture, both of which are critically important. Our governance philosophy is that we maintain a federalist governance approach, meaning that our goal, and I believe the reality, is that we seek to have a thin corporate veneer, but to really delegate as deeply and broadly decision-making authority into the organization. We want decisions to be made by the people who are closest to the shop floor, closest to the customer. And it's something that I think we're good at. It's not easy to do. It's something many people talk about, but it is our reality. It's something that we uphold, we live up to, and will continue to be really a central building block in our ideology as we move ahead into the future. The second is culture, where if you were to look at our culture as expressed through our values, they're fairly conventional. It's integrity, commitment, accountability, innovation, and respect. But the devil's in the details. These aren't merely words that are hanging on a conference room wall and have some kind of Dilbert-esque connotations to them, but rather, we really believe in this stuff, and we try and walk the walk. Every time I have a significant meeting with employees, I talk about our mission, I talk about our values, and I talk about what we do to exhibit those values overall. But most fundamentally, beyond the convention, I would tell you that our culture, again, distills down into an entrepreneurial spirit where we are okay with managed risk. We are okay making mistakes. We are a learning organization that is nimble in terms of how we organize to exploit opportunities. And as we gain scale, it's harder and harder to do that. But as a consequence, we focus more and more doggedly on making sure that we're institutionalizing these components. And I think it's real. We're not perfect at it. Nobody is, but I think we're better than most in being true to a culture. And that's critically important, not only in the strategic evolution of the company and the tactical achievement of financial and operational objectives, but also in employee engagement, which is more important than ever before, and really represents the future value of the company. And so everything is related, and we're aware of that, and we're very deliberate in how we try and cultivate that and nurture it.
And as you look out over the next, call it 3 to 5 years, what do you think are 3 things this company absolutely has to get right for the stock to be a good investment for both your investors and your employees?
Yeah. So firstly, I would tell you that given the macro environment where we believe that higher levels of inflation are here to come, Firstly, we have to get the organic growth right and the price cost equation right. We need to be effective in implementing and evolving our pricing heuristics to stay ahead of inflation. We believe we've got a good jump start on this. Feel confident about our ability to gain price, but we think we can be better at this in a way where it's more closely correlated with the value that we are delivering to customers. So that'll be an important factor, and we feel good about our ability to do that. Secondly, given the global supply chain dislocation that we've seen over the breadth of the COVID pandemic, continuing into the current year. This has been a strength for the business. We have not been immune from supply chain issues. We certainly had our share of brush fires, but overall, we've been effective in managing this. And as the global supply chain continues to evolve, and as we see changes in commodity pricing patterns, as we see a greater general move toward onshoring activity, we need to be effective in how we manage the overall global supply chain. And again, past is prologue. We've been very successful for nearly 2 decades in doing this. We're confident about our ability to do that prospectively. And then the final piece is on the inorganic growth. For us to be a compounder, we have to deliver on the inorganic growth, as we have done throughout our history. I would tell you that right now we've got a great M&A pipeline. And that it gets better as time passes and our capabilities improve. But to be clear, we need to continue to deliver the inorganic growth to really add that, that final sizzle to the overall compounding story. Again, we feel pretty good about where we are and how we've demonstrated our capabilities historically.
And we'll close with the question that I ask all of our guests. So what would you say is the most misunderstood or underappreciated aspect of your business?
I would say top of the list, Ben, is the story about nuclear power, where the views on nuclear power are different depending on the nationality of the person you're talking to. But Americans, in particular, tend to think that nuclear power is a declining industry, and it absolutely is not. And as you've heard today, the dynamics are stronger than they have been in decades, and are likely to be so for a very long period of time into the future. I'd say that's the number one issue, and that as we walk through that and talk about the unique dynamics that we experience, that we enjoy as a company in that market, then you generally see light bulbs going on and people understand it, and they understand that this is a tremendous growing perpetuity for us as a business, and something that we should be excited about and relish.
I like that, because I'm always interested in a situation in which you have a bunch of U.S. based investors who have a specific perception of any kind of whatever a market is. If it's different outside the U.S. and we're not familiar with it, I think there's an opportunity for people to get get their arms around that. So yeah, this has been great. Tom, thanks so much for taking the time. Thanks so much for sharing the story. I'm looking forward to seeing what you guys have in store over the next few years.
Thank you, Ben. It's been a real pleasure.
That's it for our show today. We hope you enjoyed the conversation. We recognize that you have a lot of different podcast choices, and we appreciate you spending the time with us. We are continually working to make the show better, and we would love your feedback. The more candid and honest, the better. And if you have any suggestions for public company CEOs you would like to see on the podcast, please let us know. And of course, warm intros are always appreciated. Please feel free to email us at podcast@covestreetcapital.com with your comments or suggestions. Thanks again, and stay tuned for the next episode of Compounders, Anatomy of a Multibagger.